Let's welcome our market master for the day, Kenneth Andrade, Head of Investments of IDFC Mutual Fund. Good morning, Kenneth, and a very happy New Year to you. How good will be the New Year to the Indian indices? After having done a 30-31% last year, can we repeat the feat?
If I look at the markets on a longer term and sustainable basis, I think things are falling into place over a longer term structure. But if I just rewind into looking at it from a near term basis, I think you will continue to get some kind of volatility into 2015. While you have liquidity support that is there, what is absent in this calendar year is valuation support. And at least in the near term, for the next couple of quarters, we do not see earnings accelerate to justify some part of where corporate India actually trades from. So to repeat 2014, it will be a tall task. It will depend upon how liquidity comes into this entire market, and we would have to have a sustainable re-rating of the Indian equity markets, which may not show up on the near-term earnings. So expectations should remain a little muted in 2015. Longer term, the structures of balance sheets and of corporate India are falling into place. It's a gradual repair process, and it will take its time.
Okay. Kenneth, hi, good morning, and Happy New Year to you and your entire team at IDFC. When you say that the structural issues are falling into place, can you highlight for us what have been the big positive takeaways in your mind, and how do you approach it from a market's point of view?
The way we've been looking at corporate India is essentially looking at how balance sheets are falling into place. And if you have an environment where corporate balance sheets are completely unleveraged and are extremely profitable, that's essentially the starting of a real capex phase in the economy. Right now, from a top-down basis, even from a government point of view and corporate point of view, the environment continues to remain reasonably leveraged. You've got enough of capacity which is existing on the ground. Some of them have been productive, some of them are not productive, which can be utilized if demand actually kicks in. So the first element of all of this happening is that you have to stimulate demand in some way for existing capacities to get used. That will bring through cash flows on the system and higher capacity utilizations, and that would transition towards the next round of capex growth. I think what's changed on the ground is there's been a capex freeze across the environment, and that's good because existing capacities can price themselves into the environment. You've got a lot of help coming in from the policy side, and that's thanks to a stable government that is there. You still have reasonable amount of easy liquidity and low cost of liquidity, which is essentially a part of what the global environment is all about. So if we can actually use all these, the policy environment which is changing and also the global liquidity that is there, and stimulate demand in the domestic environment, I think India can put its act together in the next year or two, and you should see a higher tick up in earnings into 2016 and 17 there onwards.
Okay, well, but at the moment things don't seem to be really picking up at any decent clip. We just had reports from CLSA downgrading Hero Moto and Bazaar because the sales numbers are not moving. That's what they're getting from the retail trade. These are very ominous telltale evidence of lack of growth. What are you working with in terms of earnings growth this year and FY16?
I think this year it will be fairly muted. So if I just move into 2015 and some part of 2016, I just put it in between 11 to a 14% growth rate over the next 2 years.
Oh, 2 years.
So that's not, over the next 2 years, between 11 to a 14% growth rate over the next 2 years.
So in that case,
that's reasonably good enough.
No, in that case, Kenneth, is for a person looking for 1 year returns, Is fixed income a better place just for this year, 2015 calendar?
I don't think there's a very big arbitrage between the two asset classes at this point in time. Equities will do well because you have reasonable amount of liquidity and balance sheets are not growing. So capital will get efficient out there. Okay. On the other hand, and when I say balance sheets are not growing, that effectively flips over to where the fixed income side also works. The demand of credit also will come off the cliff, will fall off the cliff. And that's where the fixed income market will actually come through. So the arbitrage, I mean, give or take 6 months, and you have to play it very finely. Exists, or the opportunity exists for both these asset classes in this calendar year. To say that fixed income will do better than equities or equities will do better than fixed income, I think equities. I'm not sure we can get a handle on how liquidity will play out. In fixed income, yes, it seems to be a better place to be in at this point in time. Equities will give you the volatility.
All right. I was just going through your IDFC Equity Opportunity Fund, and in the sector allocation, you have increased exposure to the technology sector. What is the expectation from earnings season this time around in technology? We have Infosys reporting numbers tomorrow, and since Q3 is a seasonally weak quarter, if there is a dip, would you advise buying into these heavyweights?
This is an industry which is, I mean, it generates cash flow. They've got very robust balance sheets. They continue to get market share internationally, and into a quarter two, there will be reasonable amount of challenges. So we're not really looking at this industry from probably a quarter or 2 quarter point of view. Over a longer term period, they have created reasonable amount of reasonable sized businesses on the ground, and I can't see any reason, given the advantages that these companies have, they can't continue to do the same over a period of time. Now you'll have to take into account the valuations of where these companies trade at, and if Q3 actually gives you a opportunity or a dip in the valuation parameter, I think you should be more forthcoming to add these to the portfolio, which is what we will be on the lookout for.
Okay, this year, how would the incremental gains be distributed sectorally? Would it be banks like last year? Who would be the top gainers this year?
If we look at even last year, across the 4 quarters, you had 4 different industries that actually led the market, starting with capital goods and ending with the banking system. I would expect 2015 to be very similar. The only difference that might just crop up towards the end of calendar year 2015 is you might just get a sector leader which would lead into the next couple of years. But it's too early to actually call what that sectoral leader could be. Okay, so 2015, it should be a mix and match. I'd rather go bottoms up at this point in time. I'd rather look at companies and businesses and probably industries that have bottomed out in their entire cycle, and look at if there are gaps in valuations that exist in the market, which is reasonably hard to capture at this point in time.
Okay. In your fund, I was noticing that you have a lot of stocks which have, especially in the mid-cap space, which have done exceptionally well in the last 6 to 12 months. One of them is Ashok Leyland. Would you continue to increase your allocation into these spaces, or do you think that now the time has come to churn?
If we look at it from a bottom up, and some part of the entire portfolio, of a very large part of that entire portfolio is about trying to capture category leaders out there, and and over a period of time we've been able to see companies who have gained market share, who have deleveraged balance sheets and have grown have grown capital efficiency structurally because of the nature of the business, because of their market share gains. They've been able to grow capital efficiency structurally for an extremely long periods of time. So that's what we are on the lookout for. So it's been a new addition to the portfolio. Hopefully he will hold on to his market share, or these companies hold on to their market shares and continue to deliver profitability despite the challenges in the business.
All right, we'll leave it at that, Kenneth. Pleasure speaking with you. Thank you very much for joining us.